Acquiring a business? BizNexus simplifies it. Access thousands of updated opportunities in our DIY marketplace or supercharge team sourcing with OmniSource, your all-in-one platform for on-market, off-market, and coming soon deals. Scale smarter today. Learn more or book a demo at www.biznexus.com.
Disclaimer from the always present legal team. Podcast conversations don't necessarily reflect the views of BizNexus Incorporated. Everything you hear is informational news and updates from around the industry. We're not recommending any investments. We're not offering any investment advice. Be sure to do your own homework.
Hey everyone, and welcome back for another deep dive. Today we're going to be looking at private equity.
Okay.
Specifically, we've got a report here that looks at the state of the PE landscape as of late 2024. And let me tell you, it is a fascinating time to be looking at private equity.
Interesting.
After a couple of kind of sleepy years, things are really exploding. In fact, deal value is up 36%.
Wow.
Which is a serious comeback story. So we want to unpack what is driving this resurgence. And to help me make sense of it all, I've got an expert here who can help us connect the dots between the data points and give us the so what.
Yeah, I'm excited to dig into it. It's great to see this level of activity again. You know, the report really does underscore this sort of dramatic shift in momentum, both in terms of just the sheer volume of deals that are happening, but also the dollars involved.
Yeah, so a 36% jump, it's got to be more than just a market correction. It suggests that there are some fundamental forces at play. What's changed so dramatically?
That is the million-dollar question, isn't it?
Yeah.
One significant factor, I think, is the closing of the valuation gap.
Yeah.
For a while there, buyers and sellers were just in completely different universes when it came to, what things were worth.
Right.
And it was really hard to get deals done because of that.
Right.
But what's fascinating is we're now starting to see a little bit of a convergence. Investors are reassessing risk, sellers are kind of adjusting their expectations, and suddenly deals are getting done.
So it's not just that money's cheap again. It's there's almost this renewed sense of shared reality between buyers and sellers.
Yeah.
But obviously deals of this size still need fuel. So where's the money coming from?
You hit the nail on the head. Financing is absolutely critical. And the good news for PE firms is that there are a lot of sources of capital right now. Both traditional banks and private credit funds are very eager to lend.
Okay.
We're seeing U.S. leveraged buyout loan volume is up a massive 65% in Q3, hitting $59 billion US.
Okay, now this is where things get really interesting for me. Because all this easy money flowing into PE doesn't happen in a vacuum, right?
Yeah.
Does this surge in lending have broader implications? Could it potentially create ripple effects throughout the whole economy?
Absolutely. This influx of capital into the PE space can influence everything from interest rates to the types of businesses that are getting funding. And the increased competition among lenders could mean more favorable terms for PE firms, which then impacts the deals that they pursue and the returns that they generate. It's a complex ecosystem, and changes in one area can have, cascading effects.
Speaking of areas ripe for investment, I got to admit, I'm particularly fascinated by what's happening in the tech sector. It seems like every week there's another mega deal being announced. What's driving this laser focus on tech?
You're picking up on a major theme here. Tech is white hot right now, and there are a few key drivers at play. One is this anticipation of interest rate drops. That makes growth-oriented companies incredibly appealing to investors. And tech, particularly emerging fields, is kind of synonymous with growth potential.
It's not just a short-term play, though, right? Tech, particularly areas like data infrastructure, are seen as kind of a solid bet for the long haul. This is the foundation of the entire digital world. It just seems like a sure thing as we move forward.
Exactly. Think about cloud computing, the Internet of Things, artificial intelligence, even the metaverse. All of these things rely on robust data infrastructure. And then you layer on top of that the explosion of generative AI, which is driving just an exponential increase in the need for data processing and storage capabilities. We're not talking baby steps here. Some predictions estimate that generative AI alone could increase data workloads by 50 times by 2028.
50 times? That's seriously impressive.
It is.
And it's not just speculation, right? Blackstone's massive $16 billion acquisition of AirCrunk a data center company. That just puts an exclamation point on this trend like. They're clearly positioning themselves for a future that is dominated by data.
That acquisition is a perfect illustration of how PE firms are strategically aligning themselves with the future. They're not just chasing short-term gains. They're betting big on the long-term potential of tech, especially as data becomes like the lifeblood of the digital economy.
So we've got dropping interest rates making growth companies more attractive. We've got the long-term potential of tech as kind of a safe bet. And then this just enormous surge in demand for data infrastructure thanks to AI. It's like a perfect storm brewing in the tech sector.
It is.
No wonder PE firms are piling in.
And that enthusiasm seems to be extending beyond just tech. If we look at the kind of broader sentiment, the overall outlook on PE is surprisingly bullish. The EY report showed 74% of general partners expect deal activity to continue increasing over the next 6 months.
Wow. That's a pretty resounding vote of confidence. I'm curious, though, given the cyclical nature of PE, are there any potential risks or warning signs on the horizon that could kind of derail this boom? Or are we all clear sailing for the foreseeable future?
It's a great question, and it's always important to be aware of potential headwinds. However, what's interesting is that the biggest thing holding back even more deals right now isn't access to capital or valuations, but rather a lack of high-quality assets coming up for sale.
So it's not a lack of money or willingness to invest. It's a shortage of companies that fit the bill.
Exactly.
That's a fascinating bottleneck. It speaks to the strength of the current market. But it also makes you wonder, like, what does this tell us about what PE firms are looking for and where they see value being created?
That's a very astute observation. This scarcity of attractive targets is forcing PE firms to be even more discerning and strategic in their approach. And it begs the question, what kinds of businesses will be most appealing in this environment? What will it take to stand out and catch their eye?
It's like they're on a treasure hunt. But the map is constantly changing and the prize is getting harder to find.
Exactly. And this hunt for high-quality assets leads us to the other side of the PE coin, exits. Because it's not just about buying. It's about generating returns for investors. How PE firms cash out is just as important as how they get in.
Right, because PE investments aren't like playing the stock market. These investments are typically locked up for several years. That puts a lot of pressure on firms to eventually unlock profits for their investors.
Precisely. And while the exit market is picking up steam, it's not quite as dramatic as the buying frenzy that we've been discussing. But we are seeing a resurgence in IPOs as a popular exit strategy. Softening interest rates and easing inflation are making going public a more appealing option for companies looking to raise capital.
Hold on, though. Haven't IPOs been pretty sluggish recently? Like, weren't we just going through a phase where companies were shying away from going public?
That's true. There has been some hesitancy. But what's interesting is that the PE-backed companies that have gone public this year have performed remarkably well for investors.
So it's not just that IPOs are back on the menu, it's that PE-backed IPOs are particularly hot. What's driving that outperformance? Is it just the overall market sentiment, or is there something more specific about these companies that's attracting investors?
That's a great question, and it's a bit of a puzzle. It could be a combination of factors, including the rigorous vetting and operational improvements that PE firms typically implement before taking a company public. It also suggests, I think, a certain level of confidence in the PE firm's ability to identify and nurture successful businesses. Whatever the reason, this strong performance is likely to encourage more PE firms to consider the IPO route for exits in the coming months.
So it sounds like things are looking up on both ends of the PE spectrum, both buying and selling. I'm curious, though, even with all this positive momentum, are there any underlying pressures or challenges that these firms are facing? After all, they're not operating in a vacuum. They have investors to answer to.
You bring up a crucial point. Despite the positive outlook, PE firms are still feeling the heat from their investors. The limited partners, or LPs, to deliver strong returns. Remember, those LP investments are locked up for a significant period. So they're understandably eager to see their money grow.
So even with all the excitement around deal-making and this optimistic market outlook, there's a very real sense of urgency and accountability within these firms?
Absolutely. They can't just sit back and ride the wave. They're under constant pressure to make smart investments and generate profits for their LPs. The EY report revealed that over 70% of general partners reported feeling at least moderate pressure from their LPs to distribute profits.
Wow, over 70%. That's a significant majority. It really underscores the intense pressure these firms are under to perform even amidst a booming market. It's not all champagne and celebrations. There's a lot of hard work and strategic maneuvering happening behind the scenes.
Exactly. And it's important to remember that PE isn't just about buying and selling companies. It's about actively engaging with those companies to improve their performance and unlock value. They're not just financial investors, they're strategic partners.
So they're rolling up their sleeves and getting involved in the nitty-gritty of running these businesses. What does that look like in practice? Are they focused on cost-cutting expansion strategies, new product development? What's the game plan?
That's where we see a really interesting shift in focus this year. Last year, amidst all the economic uncertainty, PE firms were laser-focused on cost-cutting measures for their portfolio companies.
Yeah.
It was all about weathering the storm and protecting the bottom line. But this year, the emphasis has shifted to revenue growth. They're prioritizing strategies to help those companies actually expand and generate more revenue.
So it's a move from a defensive posture to a more offensive one, from battening down the hatches to setting sail for new horizons.
That's a great analogy. And it makes perfect sense considering the overall positive sentiment in the market. When the economy is looking up, PE firms are more inclined to invest in growth and expansion, rather than just focusing on cost containment.
It's like a sign of confidence, a belief that the good times are here to stay, at least for the foreseeable future.
Exactly. And this shift in focus from cost-cutting to revenue growth is reflected in the data. EY's survey showed a clear increase in the number of general partners who are prioritizing top-line growth for their portfolio companies compared to last year.
So it's not just anecdotal, it's a quantifiable trend backed up by hard data. We're seeing a real shift in how PE firms are approaching their investments, moving from a focus on efficiency and cost control to a more growth-oriented mindset. It's like a whole new chapter is unfolding in the PE playbook.
It's an exciting time to be watching this space, that's for sure. This convergence of favorable market conditions, shifting investment strategies, and the rise of new technologies. It's creating a really dynamic and unpredictable landscape.
It sounds like we've only just scratched the surface here. There's so much more to unpack and explore in this ever-evolving world of private equity.
Absolutely. And that's what we'll be diving into in the next part of our deep dive. We'll delve deeper into the specific strategies that PE firms are employing to drive revenue growth, explore some of the criticisms and challenges that they're facing, and uncover some of the cutting-edge trends that are shaping the future of this dynamic industry.
Sounds like we've got a lot more ground to cover. Don't go anywhere. We'll be right back.
After a quick word from our sponsors. Welcome back, everyone. Before the break, we were talking about this really interesting shift in focus for PE firms, from this laser focus on cost-cutting to a more growth-oriented mindset.
Right.
This prioritizing revenue generation. For their portfolio companies, it's a fascinating evolution, and one that I think reflects, the broader shift in market sentiment that we've been talking about.
Right. And I think it would be really helpful to kind of dig a little deeper into what that actually looks like in practice. What are some of the concrete strategies that PE firms are employing to actually boost revenue for these companies that they own? Yeah,
it's a multifaceted approach for sure. But one key area is investing heavily in technology and digital transformation. A lot of PE firms are recognizing that. For their portfolio companies to thrive in today's landscape, they really need to be embracing the latest technologies, whether it's cloud computing, data analytics, automation. These tools can enhance efficiency, open up new markets, and ultimately drive revenue growth.
So it's not just about acquiring tech companies. It's about helping their existing portfolio companies become more tech savvy.
Exactly.
It's like giving them a digital makeover to compete.
Yeah.
In the modern world.
Precisely. It's a recognition that technology is no longer optional. It's fundamental to success. But goes beyond just implementing new software. We're also seeing a big emphasis on helping portfolio companies really refine their sales and marketing strategies, particularly in the digital realm.
So it's not just about building a better product or service. It's about making sure the right people know about it and can easily access it. Are we talking things like SEO optimization, social media marketing, targeted ad campaigns?
Absolutely. It's about maximizing reach and engagement in a world that's increasingly digital first. But PE firms aren't limiting themselves to the digital realm either. We're also seeing them really encouraging and facilitating international expansion for their portfolio companies.
So tapping into new markets overseas is kind of a key part of the growth strategy.
Yeah.
It makes sense. I mean, there's a whole world of potential customers out there. But navigating international expansion can be tricky. Are PE firms kind of stepping in to provide guidance and support in that arena as well?
Absolutely. Many PE firms are uniquely well positioned to help their portfolio companies navigate the complexities of going global. They can offer resources, expertise, connections to help them establish a foothold in new territories. It's part of that shift we talked about, being a true partner, not just a passive investor.
It's like they're acting as a strategic Sherpa
Yeah.
guiding these companies through uncharted territory.
Yeah.
But, we've been talking a lot about the positive aspects of PE, all this growth and innovation and strategic support. It's important to acknowledge that there's another side to the story, right?
Yeah.
There are criticisms and concerns surrounding the industry as well.
You're right. No industry operates without scrutiny, and private equity is no exception. One of the most common criticisms, I think, is that PE firms prioritize short-term profits over long-term sustainability. There's this perception that they might, implement really aggressive cost-cutting measures or even layoffs to kind of quickly boost returns.
So it's that classic image of the corporate raiders swooping in, slashing and burning, and then flipping the company for a quick profit, leaving behind a trail of damage.
That's the stereotype,
Yeah.
yes. And while there have certainly been instances where that's happened, it's important to remember that it's not always the case. Many PE firms, I think, take a much more long-term approach, recognizing that investing in the health and growth of their portfolio companies ultimately leads to greater and more sustainable returns down the line.
So it's not always a zero-sum game. There's room for win-win scenarios where both the PE firm and the company, including its employees, can benefit.
Exactly. There are plenty of examples where PE firms have partnered with companies to foster growth, to create jobs, and generate value for all stakeholders involved. It's about finding the right balance and aligning incentives for long-term success.
That makes sense. But what about the impact on competition? There's concern that, PE firms consolidate industries, leading to less competition and potentially higher prices for consumers. Is that a valid concern?
It's a valid point, and one that I think regulators are definitely watching closely. It's true that PE firms sometimes acquire multiple companies within the same industry, which can lead to consolidation. But consolidation isn't always a bad thing. Sometimes it can lead to greater efficiency and even drive innovation, which ultimately benefits consumers.
So it's not a simple black and white issue. There can be positive and negative consequences, depending on the specific circumstance.
Precisely, and finding the right balance is where thoughtful regulation and oversight play a crucial role.
Now, looking ahead, what are some of the key trends and challenges that you think will shape the future of private equity? What should our listener be paying attention to?
One trend that I think is impossible to ignore is the increasing importance of ESG, environmental, social, and governance considerations. Investors are becoming far more aware of the impact that their investments have on the world, and they're demanding that PE firms factor these considerations into their decision-making.
So it's not just about financial returns anymore. It's about making sure those returns are achieved in a responsible and sustainable way.
Absolutely. This is forcing PE firms to adapt to conduct more thorough due diligence and to engage more actively with their portfolio companies on ESG issues. It's a whole new layer of complexity and accountability.
Like a whole new set of lenses through which they have to view their investments.
Yeah.
What about the rise of technology, particularly artificial intelligence? How do you see that impacting the PE industry?
Technology is already having a huge impact, and that influence is only going to grow. We're seeing AI being used to analyze massive data sets, to identify potential investment opportunities, to streamline due diligence, and even to manage portfolio companies more efficiently.
So AI is becoming a virtual partner, helping PE firms make smarter decisions and operate more effectively.
Exactly. And this is likely to lead to greater efficiency, faster deal making, and potentially even higher returns. But it also raises some interesting questions about the future of human expertise in the industry. If AI can do so much, what role will humans play?
That's a big question. It's a bit like that classic sci-fi dilemma, will robots take over? But I imagine it's more nuanced than that, right? It's not about replacing humans, but augmenting their capabilities.
That's a great way to put it. I think it's safe to say that, technology will automate a lot of routine tasks, but that will actually free up human experts to focus on more strategic and creative aspects of the business. It's about humans and AI working together to achieve even greater success.
So it's about leveraging the strengths of both to create a more powerful and effective industry.
Precisely. It's an exciting time to be in this space, watching how these forces interact and kind of reshape the landscape. But it's not just about the big players and the cutting-edge tech. What about individual investors? What role does PE play in their portfolios? And what should they be aware of?
That's a great point. Traditionally, private equity has been seen as kind of the domain of institutional investors, like pension funds and endowments, because of the high investment minimums and the long lockup periods. But are things changing? Is PE becoming more accessible to individual investors?
There's definitely a movement towards democratizing access to PE, making it more accessible to individuals. We're seeing platforms and funds emerge that allow individuals to invest in PE with lower minimums and essentially shorter lockup periods.
That's intriguing. So it's no longer just for the ultra-wealthy. Regular folks can kind of get in on the action, too.
That's the trend, yes. But as with any investment, it's crucial to do your homework, understand the risks, and make sure that PE aligns with your overall financial goals.
Right. It's not just about jumping on the bandwagon because everyone else is doing it. It's about making informed decisions that fit your individual circumstances.
Exactly. And it's important to remember that PE investments are typically illiquid, meaning you can't easily cash out if you need to access your money quickly. It requires a long-term investment horizon and a tolerance for risk.
It's a good reminder that diversification is key, right? Don't put all your eggs in one basket. Spread your investments across different asset classes to manage risk and potentially enhance returns.
Couldn't agree more. Diversification is essential for any savvy investor.
And speaking of diversification, let's shift our focus to another aspect of the PD landscape that's been gaining a lot of attention lately: impact investing.
Yes, impact investing is all about aligning your investments with your values. It's about investing in companies and projects that are aiming to generate positive social or environmental impact alongside financial returns. It's about using your capital to make a difference in the world.
So it's not just about making money, it's about making a positive contribution to society or the environment. Is that something that's gaining traction within the PE world?
Absolutely. More and more PE firms are recognizing the potential of impact investing. And it's not just about ethics. It's becoming increasingly clear that doing good can also be good for business.
It makes sense consumers are becoming more conscious of the impact of their spending habits and are more likely to support companies that align with their values.
Exactly. It's about creating a virtuous cycle where doing good is good for business and good for the world.
So we've covered a lot of ground here, from the resurgence of PE deals to this shift towards revenue growth, the criticisms and challenges facing the industry, and these exciting trends like ESG, AI democratization of access, and impact investing. It's clear that the world of private equity is incredibly dynamic, complex, and constantly evolving.
It certainly is, and there's so much happening. It can feel overwhelming to keep up with all the latest developments. But I think it's crucial for our listeners to stay informed, to ask questions, and to be critical of both the positive and negative aspects of this industry.
Well said. It's all about informed engagement, right? Understanding the forces at play and making conscious decisions about how to participate.
Exactly. And with that in mind, we'll wrap up our deep dive into private equity with some final thoughts and key takeaways in our next segment. Stay tuned.
Welcome back to our deep dive into the world of private equity. We've journeyed through the current boom in deal activity, the shift in focus towards revenue growth, explored some criticisms and challenges that the industry faces, and touched on these exciting trends that are shaping its future.
Yeah, it's been quite a whirlwind tour, hasn't it? From the nitty-gritty of deal-making to the broader impact on businesses and investors and the economy as a whole.
Absolutely so. As we wrap up our exploration, what are some key takeaways that you want our listener to walk away with? What's the big picture here?
Well, I think the most important takeaway is recognizing just the sheer power and influence of private equity in the global economy. It's playing an increasingly significant role in shaping industries, driving innovation, creating value. It's a force to be reckoned with.
Right, and it's not just about these headline-grabbing mega deals and these high-finance players.
Yeah.
That we see in the movies, right? Like PE impacts the lives of everyday people in countless ways, whether through the companies we interact with, the services we use, the jobs created.
Exactly. And with that impact comes a responsibility, I think, to understand how this industry works, both its strengths and its potential pitfalls.
Because knowledge is power, right? The more we understand these forces that are shaping our world, the better equipped we are to navigate them and make informed decisions, both as investors and as consumers.
Absolutely. And it's important to remember that private equity isn't a monolithic entity. There's a wide range of firms operating in this space, each with their own unique investment philosophies and strategies and values.
Right. It's not about painting the entire industry with a broad brush. We need to recognize the diversity within that industry and understand the nuances of different firms and their approaches. It's like anything else. There are good actors and bad actors and everything in between.
That's a great point, and I think that leads to another really crucial takeaway, the importance of critical thinking and due diligence. Whether you're a potential investor, a business owner considering partnering with a PE firm, or just a curious observer, it's crucial to do your homework, to ask questions, and to look beyond the surface.
Because let's be honest, there's a lot of hype and spin surrounding the world of private equity. It's easy to get caught up in the excitement or the fear, depending on your perspective. But it's essential to take a step back, examine the facts, and form your own informed opinion.
Well said. Don't just buy into the narrative. Dig deeper. Ask those tough questions and decide for yourself. And finally, I think it's essential to remember that the future of private equity is really brimming with both opportunities and challenges.
Right. We've touched on some exciting trends like impact investing and this growing focus on ESG considerations.
Yeah.
But we've also acknowledged, those criticisms and concerns that need to be addressed.
Exactly. And I believe the key going forward is finding ways to address those concerns, to promote greater transparency and accountability within the industry, and to ensure that private equity is ultimately a force for good in the world.
It's about striking that balance between generating those financial returns and creating a positive impact both for investors and for society as a whole. It's a tall order, but it seems like the industry is kind of at a crossroads where those considerations are becoming increasingly important.
I agree, and I believe that if done right, private equity can play a really vital role in building a more sustainable, equitable, and prosperous future for all. It has the potential to be a powerful engine for positive change if those involved commit to using that power responsibly.
That's a powerful thought to end on, a reminder that with great power comes great responsibility. Thank you so much for guiding us through this complex and fascinating landscape. You've given our listener a lot to think about.
It's been my pleasure. I always enjoy diving into these topics and exploring the different perspectives and possibilities. There's never a dull moment in the world of private equity, that's for sure.
And to our listener, we hope this deep dive has been enlightening and thought-provoking. We encourage you to continue exploring the world of private equity, stay curious, ask questions, and form your own informed opinions, because as we've seen, it's an industry that touches all of our lives in really profound ways. And as always, thanks for joining us on the deep dive. Until next time, keep learning, keep exploring, and keep diving deep.